Hi, this is Scott McClymans at CEO Velocity. I want to talk to you today about Customer 360, which I've developed with my partner Solve in a business intelligence application called ClickSense. And we're going to be talking about the all-important executive dashboard. I get excited about this screen. It just has a ton of strategic information that can give direction to your company. And in particular, we're going to be speaking today about banks and credit unions. The first thing we need to do is understand that we have created profit groups. End zone, they have scored. Red zone, scored a little bit, close to the end zone. Mass market and lower tier. And you can see that about 10% of the households are in the end zone. That equates to about 5,300 households. And they've made about 80% of our profits. And this is pretty typical in the banking industry. What I find, however, is that everybody knows this, but hardly anybody does anything about it. And I think that's a big mistake. I think there's a world of opportunity for banks and credit unions if they embrace this, if they embrace these households and understand how to manage them. We'll talk about that a little more in our video series. But right now, let's just understand the differences. That end zone household makes us about $27,000 per year. That's about 5 times more than the red zone household. Red zone still profitable, but not nearly like the end zone. And of course, mass market, somewhat profitable. We'll take them, but not quite where we would like them to be. In the lower tier, has negative profitability. Now, in terms of product holdings, for banks and credit unions, we know that asset liability management is critically important. So, for example, our loans are going to be concentrated in the end zone, and we'll look at those more in subsequent sheets, subsequent videos. Loans and deposits all concentrated here. A lot of fee income concentrated here through investments. So we really need to, for the CFO, we're going to need to consider this a great deal for our asset liability mix, the duration of those loans and deposits. Now, of course, we like it when our customers and members buy into our product line, when they buy lots of our products, because that means that they are deriving a lot of value from us. We're creating things of value which they are enjoying buying and which help them. In this case, what we see is that there's not very much differentiation between our end zone households at 3.8 services per household and our other lower profit groups. That causes us concern. Why is that? Because the fewer services per household, the greater the attrition risk. And attrition risk is bad. I call it the unseen or the invisible risk that all credit unions and banks have. So in this case, our end zone households, there are about 1,800 of them that are at risk. They only have 1 or 2 services with us. Well, when you multiply 1,800 times $27,000, that's a lot of risk. That is a lot of profitability that's at stake. And just remember, these are the folks in the end zone who keep the lights on. They enable us to serve our other customers, and personally and professionally, they allow us to have salaries. If we're a bank, they return money to our shareholders. If we're a credit union, they return money to our members and enable us to reach the rest of our community. So they're critically important. That's why we want to really reduce the amount of these end zone customers who have a high attrition risk. So as we think about this sheet here, and we're thinking about the executive committee, the C-level people, as well as the board, we have some action steps that we want to take. First of all, we want to have a deeper understanding of who these red zone households are. Are they small businesses? Are they retirees? Are they Gen Xers? Are they millennials? What's the mix of these customers or members, and what is valuable to them? How can we create value for them? That's step number one. Number two is we want to shore up the relationship among these end zone customers, these most profitable customers or members. So we need to create some action steps, and we'll delegate these to really smart people like our chief marketing officer, perhaps even our CFO, our head of retail, our head of mortgage and consumer lending. We'll find a committee of folks who can help us create a plan to shore up these relationships. That's step number two. Step number three is within the end zone category. We would like to look at these folks who have a very low risk of attrition and develop a referral program. We want to start getting referrals from them, and so we want to be very systematic in how we go about doing this. Fourth, we want to look at the possibility of what red zone households can migrate up to the end zone, because we get a bump of $22,000 in profitability for each household we're able to migrate. So that is definitely going to be an action step for us. And then with respect to our mass market and lower tier households, for sure we want to find ones that we think through statistical modeling, etc., can be migrated upward. But also we want to make sure that our costs to service them are very low, and the processes that we're using to service them are as low cost and as automated as possible. So we've basically got 5 action steps. Now I want to zoom out and just say that if you don't have profitability on your customers, that's okay. We can come up with a surrogate. All we really need to know is we need to have a way to rank order these different customer groups relative to one another. So it doesn't have to be perfect profitability. I've run across a number of folks who kind of obsess over that. We really don't need to. We just want to rank them relative to one another and get started. And other people say, well, why do we even need to do this? This is crazy. Let's just offer value. What I would say is this. There used to be 20,000 banks and 20,000 credit unions in America. Now there are about 6,500 each, and it's consolidating all the time. Why is that? I would submit to you there are a number of reasons, but one primary reason is they haven't differentiated and understood and provided the value that their customers and members need. Therefore, they have migrated to bigger banks and alternative banks and credit unions who can create that value. I'm telling you that the ability to understand these customers and members and to create value for them and to differentiate your bank or credit union exists for all community banks and credit unions. And this tool, this Customer 360, puts it at your fingertips. The executive dashboard here puts business intelligence and tremendous power at the hands of your executive team and your board.